In the midst of a tumultuous trading landscape, the recent surge in stocks following disheartening job opening data is akin to a ray of hope piercing through a stormy sky. The S&P 500 and other indexes have managed to trim their August losses, albeit the journey towards finishing the month in the green remains uncertain. The words of validation come from a UBS team led by the astute Chief Investment Officer, Mark Hedge. With profound insight, they reveal that the markets find themselves entangled in opposing forces, resulting in an intricate dance devoid of any clear direction. In a world where pivotal questions hang unanswered: the strength of the consumer, the intentions of investors in their rallies, and dips the path ahead is shrouded in mystery. Are we at a neutral juncture in the stocks, or is this merely a pause before a deeper plunge? The unpredictable nature of these times raises the question. Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button, leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. Amid the currents of uncertainty and market fluctuations, the recent surge in stocks following grim job opening data has offered a glimmer of optimism. The S&P 500 and other indices, battered by losses throughout August, have managed to pull back to some extent. However, the possibility of ending the month on a positive note remains a distant ambition. In this perplexing landscape, a team spearheaded by UBS's Chief Investment Officer, Mark Hedge, lends its voice. Their assessment resonates with those who have navigated the treacherous waters of this summer. They assert that the markets are ensnared in a complex web of conflicting forces, leading to a sort of financial equilibrium bereft of any clear trajectory. The very bedrock of the market stands challenged by enigmatic queries that lack answers in the present moment. The resilience of the consumer, the intentions of investors as they oscillate between rallying and retreating these riddles, shape the market's uncertain path. Is this a mere pit stop in the upward climb, or have we entered a new phase of downward momentum? Mark Hedge contends that the positioning of investors implies a return to neutrality in stocks. The S&P 500's meager 3.4% retreat from its recent peak fails to provide a substantial buying opportunity following a robust rally. This observation raises a critical question: can the market truly thrive in the absence of pronounced dips? Transitioning to a different perspective, SocTGN Rail's alarm bell rings in the form of a risk indicator. This indicator, which gauges the behavior of hedge funds, paints a progressively risk-on picture. Arthur Van Slooten and Elaine Bokobza, strategists at SocTGN Rail, highlight the importance of hedge fund positions as a barometer for market trends. Their multi-asset risk indicator, SGM-ARI, reveals the increasing willingness of hedge funds to embrace risk. This trend, embodied by a surge to its highest level since summer 2018, merits close attention. The rise of 2.7 points over the course of 13 months underscores the indicator's strength, resembling past episodes of robust recovery. Nonetheless, caution prevails. The current level of SGM-ARI, while elevated, remains comfortably below the threshold of investor exuberance. But history beckons with a word of caution, as many instances of surges in SGM-ARI have been followed by significant downturns. The implication is clear: hedge funds, once fervently backing stocks and other assets, could swiftly reverse their stance. In the rearview mirror, the strategists note the fickleness of hedge fund positioning in bonds and equity. The act of shorting stocks to hedge against a looming recession has been largely neutralized in the time that has passed since May. Recession fears, it appears, have taken an unexpected retreat, leaving behind a sense of unease. As the markets unfold, they do so against the backdrop of various events. Brown-Forman stocks dip following lackluster profit and sales, HP shares struggling amidst revenue misses, and economic concerns, Box's weak guidance causing a stumble, and Ambarella's disappointing forecast all contribute to the narrative of a market facing headwinds. Even as Hurricane Idalia wreaks havoc on Florida's Big Bend region and mutinous Gabon soldiers disrupt election results, financial markets remain their own stormy battleground. In the face of market uncertainties, do you believe that strategies based on risk indicators like SGMARI can truly anticipate market trends? Or is the market's unpredictability beyond the grasp of such tools? Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.